So Amazon reported quarterly financial results and held a conference call with Wall Street analysts where the management team revealed critical insights that changed the investment case for Amazon here in 2025 and beyond. They revealed some big changes in their spending plans for capital expenditures to build artificial intelligence, and they revealed critical information about demand for their artificial intelligence services and the growth in a critically important segment. So I'm going to discuss those details for you in this video and update my recommendation and rating on Amazon stock for you, let know what I think about this business, if it's buy, hold, or sell at current market prices.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So one of those important segments I talked about is advertising. Amazon's been increasing its advertising revenue meaningfully at a faster pace than some of its larger ad rivals, including Alphabet and Meta platforms. And in the most recent quarter, advertising revenue accelerated, jumping to $17.7 billion, and the growth rate is accelerating for the third consecutive quarter. I've talked about how accelerating growth is an important metric for investors. Acceleration just means the rate of increase is increasing. So not only is the company increasing revenue, but that rate of increase is increasing. For those of you mathematically inclined, it's that second derivative that's increasing that's so attractive for investors. It's a strong indication of organic demand for a company's products, and it's an indication of what the company's future revenue and profit will look like. If a company's revenue is accelerating, that means the company probably has pricing power and it can generate sufficient margins and profits to support growth in new categories or return capital to shareholders. The more important segment is AWS, and the management team addressed this segment, showcasing revenue increased by 20.2% up to $33 billion. Amazon's Web Services segment is the largest in this category. It's the market share leader, while its growth rate is slower than that of Alphabet and Microsoft, which saw their cloud revenue increase by over 35%, closer to 40%. Amazon is growing at roughly half that rate, but Amazon's revenue overall is much larger than those two companies. In fact, it's roughly more than double what Alphabet reported in its cloud segment in the most recent quarter. So this was an acceleration in this segment. So here we are, Amazon, two critically important segments, and they're talking about and demonstrating accelerating revenue growth. This is precisely what you like to see as an investor in a company you're investing in, with its two of its most important categories experiencing accelerating revenue growth. This acceleration was 270 basis points compared to the previous quarter, where they grew revenue by roughly 17%. This was driven by strong growth across both our AI and core services and more capacity which has come online to support customer demand. For several quarters now, Amazon, Alphabet, Microsoft, and others have been talking about how demand for artificial intelligence exceeds supply. And when you're in that position, as you add capacity, as you add supply, your revenue grows because you already have the customers that are waiting. All you need to do is increase supply and you get to sell that product to customers. And that's precisely what happened with Amazon in the most recently completed quarter. It added more capacity and quickly had buyers for that capacity. It's also forecasting that it will be adding more capacity and demand is there. So it wouldn't surprise me if the next quarter, when they report their results, if AWS segment revenue growth exceeds 20.2%, which if they do report revenue growth above 20.2% in the upcoming quarter in this specific segment, I think it'll be another positive catalyst for Amazon's share price, similar to how the share price increased following the announcement of this increase up to 20.2%. So AWS revenue increased $2.1 billion quarter over quarter and now has an annualized revenue run rate of $132 billion. The operating income in this segment was $11.4 billion and reflects their continued growth coupled with their focus on driving efficiencies across the business. They expect AWS operating margins will fluctuate over time, driven in part by the level of investments they're making at any point in time. Now they're talking about how much they plan to spend on capital expenditures, which was $34.2 billion in the third quarter. And they've now spent $90 billion so far this year. In 9 months, they've spent $90 billion. In other words, $30 billion per quarter. And they are spending this money primarily to develop these data centers optimized for artificial intelligence. So this primarily relates to AWS as we invest to support demand for AI and core services in custom silicon like Trainium, as well as infrastructure to support their North America and international segments. We'll continue to make significant investments, especially in AI, as we believe it to be a massive opportunity with the potential for strong returns on invested capital over the long term. And if you view Amazon's returns on invested capital over the longer term, you can see the company has done a relatively good job of boosting these margins up from 6% in 2016 all the way to 12.8% in the most recent trailing 12-month period, all the while adding hundreds of billions of dollars of investments in building out their infrastructure for logistics and fulfillment, and also for data centers, and now more recently for data centers optimized for AI. So when a company has demonstrated to investors a skill in allocating capital, you can be reasonable in feeling comfortable in trusting the management team to perform what they tell you that they're performing. Now, other management teams have been less successful in their capital allocation plans and have earned less trust from investors because they've told investors they're going to do something and they failed to perform what they said they were going to do, or delivered way less than what they were promising they were going to deliver. There's one obvious company that continues to do this repeatedly, where the management team overpromises and underdelivers, and yet investors continue to trust this company, which I think is misplaced. I don't think investors should grant their trust to management teams unless the management team has earned your trust based on years and years of history of demonstrating successful capital allocation. So looking ahead, they expect their full year CapEx to be approximately $125 billion in 2025. Remember, previous estimates were that they were going to spend about $105 billion in 2025. So this updated estimate of $125 billion is $20 billion more than previously estimated. And surprisingly, that's good news. And why is that good news? Because they have customers ready to purchase this capacity that they're adding to their business. As they add more capacity for artificial intelligence, for data center compute, the customers are there to purchase that demand. This would be a different story if there wasn't that demand, there wasn't those backlogs of customers waiting in order to purchase this capacity. The demand is there. They just got to bring in the supply to support that demand. Now, some investors are concerned that there's overbuilding in this category, and that might be the case. But that is not likely to show up until several years in the future. And by that point in time, Amazon's business is likely to be larger scale. And if there isn't buyers for the computing power that they have, they can always use this internally for their own use cases. For example, improving their recommender systems for Prime Video and their Shop app, where they can surface content that's more likely to generate purchases from end customers. So when you're a business of this size, you also have the ability to use these compute capacity internally if you can't sell it to third-party businesses that are looking to utilize these core services. So as I've been talking about, I think Amazon is one of the best opportunities for long-term investors right now. I've had it rated as one of the best stocks to buy this year, and the intrinsic value per share I calculated is $304. The current market price is $249. So this stock is undervalued, and I would be willing to pay a fair price for a business of Amazon's caliber, but I'm able to buy it at a discount, which I took advantage of a few weeks ago, and I added Amazon shares to my own portfolio. By the way, did you know about our exciting channel membership program? You get so much for less than $5 a month, including dozens of exclusive videos, access to exclusive research on over 100 stocks, and early access to many of my videos before everyone else sees them. Click that join button below to learn what this program is all about.